welcome to this special show. I'm Ritu Singh. The Reserve Bank of India has held key policy rates for the 7th time in a row as expected. The MPC, in a 5-1 majority, decided to keep the repo rate unchanged at 6.5% and the stance unchanged as well. The central bank stuck to its earlier GDP growth projection of 7% for FY25, contrary to market expectations of a potential upgrade to the forecast. Governor Shaktikanta Das said that inflation, which he called the elephant in the room, was seen to be headed towards the woods, and he hoped that the elephant stayed in the woods for the time being. Listen in to what the governor said.
Now, 2 years ago, around this time, when CPI inflation had peaked at 7.8% in April 2022, the elephant in the room was inflation. The elephant has now gone out for a walk and appears to be returning to the forest. We would like the elephant to return to the forest and remain there on a durable basis. In other words, it is essential in the best interest of the economy that CPI inflation continues to moderate and aligns to the target on a durable basis. Till this is achieved, our task remains unfinished.
Okay, Latha Venkatesh is also with us with her editor's take on the Reserve Bank of India policy. Latha, over to you.
Well, I think you summed it up very well. There is absolutely no change. I can't see a better example of the word status quoist. And as you pointed out, even the growth expectations or the growth forecasts have not been revised higher, although they were revised higher in the bulletin, which just came out, the March bulletin. So that's a bit of a surprise. Otherwise, it's totally unexpected lines. So let's look at how things will pan out and parse the details of the press conference. We have our guests with us, Samiran Chakraborty, the chief economist at Citi, Mridul, Saggar, a former executive director at Reserve Bank of India and former member of the MPC, now professor at IIM Kozhikode. We also have with us Prasanna, who of course heads global markets and treasury at ICICI Bank. In a bit, we are going to be joined by the biggest banker, Chairman of State Bank of India, Mr. Dinesh Khara. Gentlemen, thank you very much indeed for your time. Well, Samiran, let me start with you. What's the key takeaway that you got in terms of this reference to potential growth? The governor says potential growth will be relooked. So if it is revised higher, does the neutral rate also go higher? Is that a hawkish statement?
Thanks, Latha, for having me. And I think this is something which we need to understand a bit more carefully. Maybe as you were referring to the fact that the RBI has kept the FY25 growth numbers unchanged could also be connected to this need to reassess the potential growth number, which they are going to do once the FY24 full year GDP is released end of May. But if you look at it, there are two opposing effects here. So one effect is that if the potential growth number is relatively higher, then one can justify that the real neutral rate could be somewhat higher. And then on the basis of that, the nominal policy rate could also be slightly elevated. But on the other hand, if your potential growth is higher, then for the same level of actual GDP growth, the output gap will be relatively lower. And from that perspective, the need to have a slightly higher nominal rate is not going to be there. So depending upon which one of the two effects are going to dominate, the impact on the nominal policy rate could be different. We all know that in the past, RBI has put the real neutral rate at 80 to 100 basis point around FY22. But historically, this number used to be around 150, 160 basis point. So has things normalized? Are we going back to that 150, 160 neutral rate? But at the same time, even with this 8% kind of GDP growth, the output gap is not very positive just because potential growth is higher. I think that's the debate that we'll have to settle once this reassessment is done.
Why don't I toss that to the man who has already worn the MPC cap up until recently? Mridul, how should we assess this? if you were in the MPC, or how will the people in the MPC assess this? Will they now calculate that the real rate is not 0.8 to 1%, but higher? What will you prepare us for in terms of the RBI's thinking?
Latha, my personal view was that we were always higher. I mean, the communications of the neutral real policy rate were, the metrics were on the lower side. But actually, if you sort of estimate it with the range of tools we have in econometrics, these numbers could turn out to be higher. I mean, we are a really capital scarce economy, so like in that sense, we would all the more reason that this number should be viewed closer to the original marks of 1.5, 1.75. In the period just before the inflation targeting, it was communicated around 1 to 1.25. The problem with these numbers is they are very, very unreliable, because it depends on the period at which you estimate, it depends on the choice of technique, and even people like Orphandes of European Central Bank had sort of said we can dispense with these numbers. But this go to the monetary policy, and it's good to communicate this. And I'm happy that the RBI will do some work, and they can be in academic debate thereon, and we can take a view. But the point here is that if our real rates are positive, it's maybe inconsistent with the stance in some respect, because we have not communicated that we are tightening the monetary policy, but this tightening was justified and seems to be coming to a level where disinflation is now beginning to seep through.
Well, Mr. Prasanna, how would you weigh in on this growth debate, and also what you made of the numbers? Some of the economists we spoke to believe that even the 7% GDP growth forecast for this year and the next seems a bit conservative. Also, your take on the bond prices. Of course, we saw the 10-year not really move much after the policy. What the takeaway from that angle as well was?
So I think on the debate on whether the growth rate is conservative itself, I think the point is that since we are coming off a high base, I think the Deputy Governor did make that point. I think they wanted to be a little conservative initially. In fact, for the records, our own growth estimates for the next year is also at 7% only. And I wouldn't call it too conservative because of the fact that we are coming off a very high base. If I have to also add in to the debate on the potential and the real rate, the other point that probably requires some attention is, again, Dr. Patra's comment about how real rates will have to translate with respect to the level of inflation. And when we are at an inflation which is at, say, 50, 60 basis points higher than the target, then the level of real rates does not really, I mean, you shouldn't be looking at real rates to determine your policy. So I think from that perspective, it looks like they are really digging their heels in terms of not looking for early cut to this early commencement of a rate cut cycle this time around. And looks like from all the terminologies that they have been using, transformational economy, low CPI will benefit consumption, and so on and so forth, looks like they really want to, bring it down on a durable basis to 4%. So having said all this, the reason why bonds have not reacted much, though I would say that it's gone up by 2 to 3 basis points, I think it's the reason is because more or less nobody in the market kind of expected the RBI to even change stance, primarily because of the kind of movement in Fed rates as well as oil prices and all that over the last, say, 1 or 2 weeks. So even if there was a semblance of a chance of them changing their stance, even that was taken away because of the way the markets have moved over the last 1 week or 2 weeks. And so that's broadly the reason why the yields didn't move up. Having said that, some level of delay in the rate cut commencement might be starting to get priced in by the market. At the margin, people who are expecting rate cut to commence in August would now possibly think of October as a starting point.
I think, Mr. Chakraborty, you were also of the view that the rate cut cycle could only start much later by October. What do you still hold that view after today's policy? And, the fact that growth is so strong and RBI has more sort of leeway to act to control inflation for the time being, when do you really expect this turn? And do you think RBI can possibly act before the US Fed does, or is it only going to be after that?
So we always had a view that the first rate cut is probably October or beyond. And that's predicated on two, three things. The first is that, as you rightly mentioned, the growth numbers right now are quite robust. So there is no urgency to usher in a rate cut cycle. The second is that if you look at RBI's inflation commentary, they're insisting on saying that there are repeated supply side shocks. And in this particular MPC, the supply side shocks are quite non-specific also. So we think that they will at least want to see through the monsoon impact before thinking of any monetary policy easing. And third is what you mentioned about Fed rate. Clearly, whether RBI officially acknowledges this or not, has been some sort of co-movement in rates globally. It's not just the Fed, but even ECB also is likely to start cutting from middle of the year. So once all the developed country central banks join that rate cut bandwagon, it becomes that much easier for RBI to also start its own rate cut cycle. But I must say, in line with what Prasanna was mentioning, there is this rate cut cycle is going to be a pretty shallow one unless there is a massive negative growth surprise.
Well, then on that note, Prasanna, if you can develop that, the entire, how are you looking at the rate scenario from here on, the rupee from here on? Neil Kashkari has gone to the extent of saying that is there even a scope for any cut in the Fed? So just put all that together and assess for us, how do you see, liquidity and yields and currency moving?
So I think, Latha, what's happening on the Fed in terms of rates is that we are now going from expectations of large cuts in this cycle to a more moderate level of cuts. Maybe the start of the rate cut cycle might still be June or maybe July, but the extent to which you're going to get cuts is going to be far lesser in both calendar year 24 and 25 than what was earlier predicted. And also what is interestingly happening across the globe, all over the world, is the neutral rate of interest, which is supposed to be the rate of interest where inflation is under target and it also supports growth. That kind of a rate is actually being consistently higher. And now the market is expecting nothing less than 3.5% as the long-term neutral rate in the US. So what all this means is that you're going to probably have a much lesser extent of rate cuts in the Fed. And that's also one of the reasons why I think the Reserve Bank would be, better off trying to be cautious in commencing this rate cut cycle and would want to see the start of it before they actually go ahead. Actually, RBI has a great track record, both QT as well as rate hikes they have actually done before the Fed started. But when it comes to rate cuts, I think India as an emerging economy, it might be better off to let the Fed start and let the interest rate differential widen a bit and then, go into the rate cutting cycle. And I also agree with Samiran on the shallow rate cut cycle. We believe there is nothing more than 50 basis points as far as this cycle is concerned.
Okay. Well, Mridul, again, let me ask you to wear a central banker's hat. The growth number is seriously, it's great, but it is distorted by these indirect taxes and subsidies, the net taxes issue. It's also distorted by the way we are deflating GDP with WPI being negative. It's very funny that FY24 GDP growth is higher than FY23. I mean, that doesn't make sense. FY23 had a lower base. The fiscal stimulus was higher in that year. So, the whole thing is getting distorted by WPI. Are we really on a much stronger potential growth? And therefore, do you expect that growth is going to be, forecast higher sometime soon?
So I'm not sure we are on a higher growth potential numbers as in the terms that probably we had some scarring which never got reflected in the correct lower potential growth numbers. And now we have sort of come out of that scarring. So maybe the potential growth still hasn't increased that much as one would like it to be. So having said that, there is data uncertainty, and that data uncertainty you rightly pointed out. I mean, we don't have good services deflator to be very, very firm about what really is happening on the growth. So we have to make that allowance while forming the monetary policy. But there is no worry of excessive growth or sort of a quick recession at the moment. Or the slowdown. Recession is a misnomer for India, but even the slowdown signs are not very clear. So economy seems to be doing pretty good in the macro sense. And that's what the call of the Reserve Bank seems to be. Let us not disturb anything. Let it happen on its own, and things would just work smoothly. And that's what it is. So the way I see this issue is that we had a relief after the COVID. Now we had a recovery. And for further potential growth, we need a new wave of reforms. So would the government bite that after the elections is something we need to wait and watch, and then we can have a really, really good potential growth improvement. And I am reminded of President Roosevelt New Deal, where he clearly affirmed the need for relief, recovery, and reform. So we are now entering into a possible reform phase.
Okay, we're entering into a reform phase just before, of course, those mega elections coming up. But let me step away from growth and inflation for a bit. And Mr. Prasanna, a quick word on this liquidity coverage ratio framework that RBI is proposing to review. We've seen in the past banks, accessing both the MSF and SDF window because of this 24/7 money transfer, window remaining open. What sort of changes directionally are you expecting in this? Broadly, what is your sense?
So I think it's a good thing that the RBI has decided to kind of take suggestions and feedback. I mean, put out a draft guideline in the first place and then take suggestion and feedback from the entire market, because a lot of small items on the nitty-gritty side as well has been there as far as the LCR feedback has been concerned. So I think some of these things we don't know exactly what RBI has in mind. So we would be waiting for the draft guidelines, and then maybe we would be giving our feedback to the Reserve Bank. But all in all, I think the mood seems to be, it's quite possible that RBI might look at some of the considerations which were there, which were maybe a little bit tightening the system a little bit more than what was required. So to that extent, they might look at a fair kind of a look in for the recommendations that the industry might give. Otherwise, I think basically because of the fact that because of the 24/7 kind of world we are in, where money can really quickly flow out of the banking system, I think from that perspective, there might be some look at review as to what kind of measures that needs to be taken. So all in all, a positive thing, but I can't say anything much about it because I really don't know what's going to come in the draft guidelines. We'll probably talk about it after it's come out.
Oh, yes, and we will invite you, Prasanna. Samiran, we're running out of time. Two very quick questions. One, do you agree that potential growth has gone up, or is this all getting fuzzy because of WPI, deflator, indirect taxes, etc.? So your view of whether growth is on a higher plane, and two, your view on what you're taking away for liquidity.
So potential growth is, even in good times, a difficult thing to estimate. In most cases, what happens is that the economists apply some sort of a filter on past growth data to take out the noise on the growth rate and only look at the trend growth rate and call that the potential growth, rather than arriving at the potential growth number from the resources of the economy and full utilization of those resources, which is how ideally potential growth should be measured. In emerging markets, that's a much harder task to do. So we always end up with a subpar estimate of potential growth. Having said that, my own impression is that potential growth is probably somewhere around 7% right now. But we will be very keen to see what RBI's estimate of potential growth turns out to be. On liquidity, we think that the first stage of monetary policy easing, which is to get the overnight rates down from closer to MSF to the repo rate, that phase is already over. The RBI has very tactfully managed this February-March period when liquidity from government spending was coming into the system. They haven't pushed the system all the way up to 675, but kept it closer to 6.5. I think that's what is going to be continued from now on. Anyway, the pressure on liquidity is being eased by the balance of payment being in surplus. In fact, to me, the bigger question is that the durable liquidity numbers have already started improving. And with the bond index inclusion related flows, it is likely to increase even further. So at what point of time does RBI decide to employ its tool to suck out some of this durable liquidity? I think that is going to be a bigger problem rather than how RBI infuses liquidity.
Oh yes, and we'll see how that plays out closer to June when those bond inflows start to come in. On that note, Mr. Samiran Chakraborty, Mr. Mridul, Saggar, Mr. Prasanna, thank you so much for your time here and for helping us understand this Reserve Bank of India policy. And also, Latha, thank you for joining in with your take. On that note, we're going to have to slip into a short break, but don't go anywhere because up next, we have a special discussion lined up with the State Bank of India Chairman, Dinesh Khara.